Ray Dalio principles on gold investment. Want to invest in gold? Hold on. There's a secret from Ray Dalio you need to know first. It could change everything. Hey there. Thinking about gold as an investment? It's shiny. It's tempting. But before you dive in, let's talk about something deeper. I'm going to share 5 principles inspired by Ray Dalio, the legendary investor. These aren't just tips. They're a way of thinking. They'll help you approach gold or any investment with clarity and wisdom. Let's get started. Principle 1. Understand the economic machine. The economy is a machine. It hums, it sputters, it cycles. Gold? It's just one piece of that vast moving system. To invest wisely, you must see how it all connects. Picture this. Money flows, debts rise, governments print cash. When trust in paper money falters, gold often shines. Why? It's a safe haven. People turn to it when fear creeps in. But don't just buy gold because it's glittering in the news. Pause. Think. What's driving the machine today? Are central banks flooding the system with money? Is inflation creeping up? These are the gears that move gold's value. Back in 2008, markets crashed. Trust in banks and currencies wobbled. Gold surged as people sought safety. That wasn't luck. It was the machine at work. Dalio's wisdom is simple. Know why things happen. Don't guess. Study. Look at history. In the 1970s, inflation roared and gold prices soared. Today, ask yourself, are we in a similar cycle? Check the data. Are governments borrowing too much? Is debt piling up? These questions matter more than headlines. Gold isn't a magic answer. It's a response to specific conditions. If you don't understand the machine, you're gambling, not investing. Dalio might say, see the world as it is, not as you wish it to be. So, take a step back. Look at the big picture. The economy moves in patterns: growth, decline, crisis, recovery. Gold plays a role, but only in certain moments. Before you invest, ask, what's the machine doing right now? Is gold the answer, or is it just shiny noise? Get curious. Dig into reports. Watch interest rates. Track inflation. These are the signals that guide you. If you skip this step, you're blindfolded in a storm. Dalio built his fortune by understanding these cycles. He didn't chase trends. He studied them. You can too. Start small. Read about past recessions. See ascension. See how gold behaved. It's not about being clever. It's about being clear. The machine isn't a mystery. It's a system. Learn it. Know it. Then decide if gold fits your plan. This isn't just about gold. It's about thinking like a master of the game. Take your time. Reflect. The truth is there, waiting for you to find it. Principle 2. Diversify to manage risk. Don't put everything in one place. Not your money, not your trust, not your future. Gold can be a shield, but it's not the whole armor. Ray Dalio's principle of diversification is about survival. Spread your bets. Reduce your risks. Gold protects against inflation, but it doesn't grow like businesses or pay like bonds. It's one tool, not the toolbox. Imagine your wealth as a garden. You don't plant only roses. You mix in lilies, ferns, oaks. Each plays a role. Gold is like the sturdy hedge. It holds strong in storms but doesn't bear fruit. In 2020, gold hit record highs as markets shook. But those who only held gold missed the tech stock. Boom! Balance matters. Dalio's insight is clear. No single asset saves you. Mix gold with stocks, bonds, real estate. Each moves differently in the economic dance. When one falls, another might rise. This isn't about avoiding loss. It's about thriving through it. Think of a ship. Gold is the anchor, steady in rough seas, but stocks are the sails, catching the wind of growth. Bonds are the rudder, guiding you safely. Together they navigate the storm. Without balance, you drift or sink. Dalio might say, risk is like fire. Control it, or it burns you. So how do you diversify? Start with purpose. Why are you investing? Safety? Growth? Both? Gold might be 10% of your portfolio, not 100%. Look at history. In the 2000s, diversified portfolios weathered crashes better than gold-heavy ones. In stable times, stocks often outpace gold. The key? Don't fall in love with one asset. Love the system. Test your plan. Allocate wisely. Maybe 60% stocks, 20% bonds, 10% gold, 10% cash. Adjust as the world shifts. Dalio's hedge fund survived decades of chaos by spreading bets. You can too. Research asset classes, learn how they move. Stocks grow in booms. Gold shines in fear. Bonds pay steady. Cash waits for opportunities. Diversification isn't timid. It's tough. It's facing reality head-on. Don't bet your future on gold alone. Build a portfolio that bends, not breaks. Take a deep breath, plan it out. Your future self will thank you. Principle 3. Embrace reality, not hype. Hype is loud. Reality is quiet. Gold sparkles in ads promising riches. Buy now, they shout. But Dalio's voice cuts through. Face the truth. Gold isn't a ticket to wealth. It's a tool with limits. Look at the numbers. Over decades, gold's returns often trail stocks and real estate. It holds value, yes, but it doesn't always grow it. Don't let emotions steer you. Check the facts. In the 1980s, gold stagnated while stocks soared. Why? The economy stabilized. Inflation cooled. Gold's shine dimmed. Dalio might say, truth is your compass. Follow it. To embrace reality, start with data. Gold's price swings with fear and inflation. In calm times, it sits still. Compare it to other assets. From 2000 to 2010, gold climbed 400%. Impressive, but the S&P 500 over longer periods often outpaces it. Reality isn't sexy, it's solid. Ask yourself, why gold? Inflation hedge? Crisis protection? Fine. But don't buy because of a flashy ad. Study charts, read reports. Gold's price spiked in 2011, then fell for years. Hype blinded many. Dalio's way is different. He tests ideas against reality. You should too. Look at gold's role in history. During hyperinflation, it soars. During growth, it... System. Build your empire on truth. You can do it. Study the charts. Ask the hard questions. Gold isn't a shortcut to wealth. It's a piece of the puzzle. Embrace reality. Let it guide your choices. Principle 4. Think long-term, not short-term. Time is your ally or your enemy. Gold's price can leap or crash in a month. Dalio's wisdom is to see the horizon, not the wave. Short-term moves are noisy. They tempt you to chase quick gains. But wealth grows slowly, steadily. Gold is for protection, not speculation. Its value holds in crises, not in daily trades. Think decades, not days. Why are you buying gold? To hedge inflation? To shield against collapse? Those are long-term goals. Chasing spikes is a trap. In 2011, gold hit $1,900 an ounce. Many jumped in, expecting more. Then, it fell for years. Dalio might say, patience builds fortunes, haste burns them. Long-term, thinking means planning for cycles. Economic booms fade, crises come. Gold shines in chaos, but lags in calm. From 2000 to 2011, gold tripled. But post-2011, it slumped. Short-term chasers lost. Long-term holders stayed safe. How do you think long-term? Define your purpose. Are you guarding wealth or seeking growth? Gold guards. Stocks grow. Plan for both. Look at history. In the 1970s, gold soared with inflation. In the 1990s, it slept. Your plan should match your life's timeline. Retirement in 20 years? Gold's a small piece. Crisis. Prep? It's a bigger one. Dalio's portfolios are built for decades. Test yours the same way. Ask, where am I in the cycle? Inflation rising? Gold might climb? Market steady? It might rest. Build a strategy for the long haul. Mix assets. Rebalance yearly. From 2008 to 2012, gold swung wildly. Long-term investors held steady. Dalio's lesson? Don't chase the wave. Ride the tide. Check your goals. Align your assets. Gold's role is endurance, not sprinting. Plan for the future, not the moment. Your wealth deserves that patience. Principle 5. Learn from history. History whispers lessons. It doesn't shout, but it teaches. Gold's story spans centuries. Dalio listens closely. He studies patterns. Crises lift gold. Stability lowers it. In the 1970s, inflation raged and gold jumped over 800%. In the stable 1990s, it barely moved. Dalio might say, the past predicts the future. To learn, dig into gold's track record. During the Great Depression, gold held value while currencies faltered. In 2008, it spiked as banks failed. History shows gold loves fear. When trust in systems wanes, gold rises. When markets hum, it waits. How do you use this? Study old cycles. The 1970s taught us inflation drives gold. The 2000s showed it thrives in panic. Today, ask, what's the pattern now? Are debts climbing? Is money printing rampant? Gold might wake. Stable economies? It rests. Dalio's success comes from reading history's map. You can too. Look at gold's moves. From 1933 to 1971, its price was fixed. Then it soared when freed. Why? Trust in systems shifted. Study the data. In 2020, gold hit $2,000 as COVID shook markets. Calm years? It lagged stocks. History isn't a crystal ball, it's a guidebook. Check gold's role in past crises. In 2001, post 9/11, it climbed. In quiet times, it sits. Learn the rhymes. Test your strategy. Ask, does gold fit today's story? Is chaos brewing or is calm reigning? Dalio thrives by learning from the past. Your investments can too. Study the cycles. Plan with wisdom. Gold's history is your teacher. So, there you have it. 5 principles to make you a smarter investor, not just in gold, but in life. Understand the economy. Diversify. Stick to facts. Think long-term. Learn from history. Before you invest, reflect. Are you chasing hype or building wealth with purpose? Take these ideas, test them, make them your own. If you found this helpful, hit that subscribe button. Let's keep learning together. Share your thoughts in the comments. What's your next investment move? See you in the next video.